So it's another perfect evening we meet for this session of financial reporting and analysis. We are going to talk about a topic under International Accounting Standards 12. So IS 12. So the one for accounting for income taxes. So under accounting for income taxes, I will be talking about more of accounting for current tax and deferred tax. So in accounting for income taxes, generally we'll be talking about current taxes and deferred taxes. So, but before we go to that route, we need to start with an introduction, whereby we always say that when accounting for income taxes, they normally arise a difference between accounting profit. So when accounting for income taxes, when accounting for income taxes, they normally arise what? They normally arise differences between taxable, that is differences between the taxable profit and accounting profit. Taxable profit and accounting profit. There's this difference which arises when accounting for income taxes. So there's a difference which arises between the taxable profit and accounting profit. So what are the reasons responsible for this difference? So the reasons for this difference for taxable and accounting profit, why do we have the difference? So the difference arises due to permanent differences. So the permanent differences. So permanent differences, and we have the temporary differences. So the differences arises due to that. So when we talk about permanent differences and temporary differences, what do we mean? Like now when I talk about permanent differences, you would find that an item has been considered in one profit computation, but ignored in the other profit computation. So you will find that an item has been considered in an accounting profit computation and ignored for tax purpose. So which items am I talking about? Incomes and expenses. You find right now in accounting, there's some expenses which are considered but ignored for tax. Like now we have the expenses like depreciation. It's considered as an allowable in accounting, but disallowable under tax. The same way about incomes, you will find that an income has been considered as a normal income in the computation of accounting profit, but ignored for tax purpose. So which incomes of that kind? Like now windfall gains, government grants are considered in accounting, but not for tax purposes. So when we talk about permanent differences, is whereby you find that an item has been considered in one profit computation, but ignored in the other. So the items I'm talking about is incomes and expenses. I'm just simplifying these notes because you have them. Then when we go to the temporary differences, here, you will find that an item has been considered in both profit computations. If it's an expense, it's considered in both profit computation, both taxable and accounting, but in different time periods. The same way with an income, considered in both profit computations, but in different time periods. So time periods, we mean the accounting periods. We have two types of accounting periods. That is the accrual and the cash basis. The accrual basis and cash basis. Like now an example of an item considered here. Anyway, what you need to know is that for temporary differences, it's all about items being considered in both profit computation, but in different time periods. Like now, expenses in accounting is considered on cash basis or accrual. In accounting, an expense is considered in accrual basis. But for tax, it has to be on a cash basis. It has to be on cash basis. So, anyway, you have understood that under permanent, an item is considered in one profit computation, but ignored in the other. But on this scenario, it's all about time. They are considered in both profit computations, but in different time periods. So we have types of income taxes, types of income taxes, types of income taxes. So the types of income taxes, we have the current tax, we have the current taxes, and number two, we have the deferred taxes. We have the current taxes and deferred taxes. So you need to understand on how to do the current tax, then at the same time, deferred taxes. So we start from current taxes. We start from the current taxes. So when we talk about current taxes, it's all about taxable profit times tax rate. Taxable profit times tax rate. So now you need to know how to compute taxable profit. You need to know how to compute taxable profit. So for the taxable profit, this one, you talk about accounting profit for the year. Accounting profit for the year. You add the disallowable expenses. Disallowable expenses, you minus the allowable. You deduct the allowable expenses. So remember that once you have this taxable profit, you multiply with your tax rate, then you get what? Your current tax. You get your current tax. So we can go ahead and do a first illustration for these current taxes. That is from April 2023. There are sitting question. We can look at the receipting question. So I'm going to do the April 2023, question 5B, Roman 1. So this is the relevant question, the BXL, Manufacturers Limited. Manufacturers Limited, a small firm engaged in the production of fertilizer, purchased an item of equipment for shillings 12 million on 1st July 2018. The company provides depreciation on equipment on a straight line basis at the rate of 25% per annum. During the 4 years, from 1st July 2018 to 30 June 2022, the profit after tax and allowed wear and tear charges for the tax purposes were as follows. So you have your years there, profit after tax, allowable wear and tear charges. So corporation tax for the period of 4 years remained at the rate of 30%. Compute for each of the year ended 30 June 2019, 2020, 2021, and 2022, taxable profit and a deferred tax. So first we do the taxable profit. We do the taxable profit. So it's something which is direct. For this one, BXL, Manufacturers Limited. So we are required to do what? We are required to do taxable profit. So the formula we said for the taxable profit is the formula. Am I communicating? David, Claire, Abraham, Care, Mary, you are many here. All of you are very silent. As if I'm talking to myself. I'm not teaching myself, by the way, so you need to talk. Abraham, how are you?
I'm fine, thank you. Yes, Malimo, how are you?
How are you? How is Rwanda? Rwanda or Sudan or which country is it?
South Sudan.
How is South Sudan?
We are okay. You guys fine.
Oh, so at least you communicate. I know that I'm teaching students. I'm not talking.
Oh, yes, yes. So
this
you
online
asked
thing.
Mm.
I ask questions. All the students are silent. How would I know that I'm teaching someone?
I think we are listening. Nothing wrong.
But when you reason also, you contribute at least.
Right. So you said to compute the taxable profit.
Accounting profit for the year, according to the International Accounting Standards 12, current 3. So we say that it's accounting profit for the year. So here, what I will say is all about, I will write an heading.
Reported accounting profit there.
Just a minute, I clear the other side. So here, remember we are doing April 2023, question 5, B Roman 1. So the company is BXL. So it's called, so according to my question here, anyway, that is BXL manufacturers. BXL manufacturers. So computation of taxable profits. Computation of taxable profits. So that is for the year. For the year ended when? Our financial year was ending on 30th June. But now we have various years. So we have 30th June 2019. We have 2020 up to 2022, 2021, 2022. So we start from the accounting profit for the year, which is all about the reported profit. So we start from the reported profit. So the reported profit is, so remember you're shooting since in thousands. So the reported profit is, so the one which is given direct there, 2,400, 2,700. We have 2,850.
2550.
Then I said we add back the disallowable expenses. So the disallowable expenses, these are things like depreciations, if there's donations, amortizations, the expenses which doesn't contribute directly to the generation of business income. So here we have the aspect of depreciation. We have the aspect of depreciation. So the depreciation on the asset. So the value of the asset was stated at what? The value of the asset was stated at what? Mary, the value of the asset is stated at what?
12 million.
Yes, 5 million. So the percentage of depreciation given is?
25% per annum.
On a straight line basis. Eh?
Mm.
Yes, 5 million times 25%. So what do you have? What are you getting, Solomon? 25% of 5,000. Ayom, what are you getting? You have calculators, guys?
1,250. 1,250.
It's 1250.
Oh, yeah, yes. Is it 25%, right? 1,250.
So this one is not 5,000. So
I
what
said
was
12.
sorry?
12,000.
Oh, 12,000. So 12,000. So 25% of 12,000 is
3,000.
3,000. So remember, this is on a straight line basis. Eh? So every year will be 3,000. Then we raise allowable expenses. Allowable expenses. Eh? So the allowable expenses are the capital allowances. Eh? And the capital allowances, example of a capital allowance is all about the wear and the tear allowance. Wear and the tear. Under tax, when the asset loses value, under tax, asset loses value. When the asset loses value, we don't say it has depreciated. Eh? Under accounting is when we say it has depreciated. But under tax, we say it has done what?
Wear and tear.
Yes. So that is why we say that you find that an item has been considered in one profit computation as a allowable expense, but ignored for tax purpose. That is why we have added back here depreciation. Eh? Remember that for accounting, it could have reduced our profit. So we raise allowable expenses. So the allowable expenses, we have wear and tear, which is our capital allowance. Eh? So I can just say capital allowance. So you are given different percentages for each year. Like now, the first one is 40%. So you wear what? The asset. Eh? So the asset is at 12,000. So 12,000, 40% of 12,000. Because the first percentage for the first year is 40%. The next year we say 12,000 times 30%. The third year times 20%. And the last year is times 10%. Have you done that? So the first year you are getting
4,800.
4,000?
800.
4,800. Eh? The second year
36.
3,600.
3,600. The third one
2,400.
2,400. Then the last year
1,200.
1,200. So that now you can be able to do what? To give me the taxable profit.
The first one is negative 1,800.
Negative. It cannot be negative because I see 2,400
Oh,
plus
two
this
four.
one,
I see.
5,000
I
minus
see.
this. Yes.
I see. I see. Yeah, sorry.
600.
This one is 600. This one, 57 minus 36,
21.
21.
2,100. Yeah.
Then 5850 minus 2400,
3450.
3450. And the last one is 5550 minus 1200,
4350.
4350.
4350.
So that is fine. That is how you are supposed to determine the taxable profit. So once you know that there's a mic which is making a lot of noise, so try to mute your mic. But when I ask a question, you can unmute and answer. Is someone making a lot of noise? So remember that if you were to determine current tax, you could have determined at this level. You could have just multiplied 30% with your taxable profits. Then, now I need to introduce a bit about deferred taxes. So remember that when we talk about deferred taxes, these are future tax obligations. Future tax obligations. Future tax obligations. The provisions for future taxes. So we have methods for computing this. We have methods for computing deferred taxes. So the first one is the income statement liability method. Income statement liability method. The number two, we have what we call balance sheet liability method. The balance sheet liability method. So income statement liability method and the balance sheet liability method. So between the two methods, the one which is recommended is the second one. But before we go to the second one, let's start with income statement liability method. What does it mean? Income statement liability method. So this one, the first one, the income statement liability method, this one views deferred taxes. It views deferred taxes to arise from permanent differences. To arise from permanent differences. It views the deferred tax to arise from permanent differences. So when we talk about permanent differences, I mean the differences between the allowable expenses and the disallowable expenses. The allowable and disallowables. So we have various methods under these methods. Under these, under the income statement liability method. So we have a nil provision. Under this, we have the nil provision method. So this one makes provisions for only current taxes. So this one makes provisions for only current taxes. Then B, we talk about full provision. Full provision. it makes provisions. It makes provisions for both current taxes and deferred taxes. So if we were to use this method, if this method was to be recommended by International Accounting Standards 12, if this method, the income statement reliability method, generally, even if it's not recommended for computation of deferred tax, if it was to be recommended, we were to use full method under that, the full provision, because the full provisions make provisions for both current and the deferred taxes. It makes provisions for both the current taxes and deferred taxes. Then C, we have the partial provision. We have the partial provision. So partial provision. So this one, it makes provisions for, not, I don't want to repeat the same thing I said under full, so I could have said same as full provision. Is same as full provision, with an exemption that, not even exemption, with evidence that the tax will reverse in the future. This one you say check 2 to 3 years. So partial provision is the same as full, but we assume that there will be a reverse of that tax which we provided for the future period to the entity in the future. You check 2 to 3 years. So then, after we have done that, we can talk about balance sheet liability method. We can talk about the balance sheet liability method. So for the balance sheet liability method, this one, fuse deferred taxes. Fuse deferred taxes to arise. Fuse deferred taxes to arise from temporary differences. From temporary differences, i.e., we always say that temporary differences is equals to what? Is equals to the differences between carrying amount and what? And the tax base. Carrying amount and tax base. So what about carrying amount? So this is same as net book value. This is same as written down value. Net book value, and we have written down value. So when we talk about carrying amount, it's all about cost minus accumulated depreciation, which is a net book value. When we talk about tax base, is equals to the cost minus accumulated capital allowance. Accumulated capital allowance. Then we have types of temporary differences. Types of temporary differences. So here we have number one, taxable temporary difference. So when we talk about taxable temporal differences, here, you would say that this is when the carrying amount is when the carrying amount is greater than tax base. So then you will say that it leads to deferred tax liability. The second type, I think you are making notes at the same time, or you are following. So number 2 is what we call the deductible temporal difference. The deductible temporary difference. So this is when the carrying amount is less than tax base. So it leads to deferred tax assets. So this one is a positive temporal difference. This one is a negative. The taxable is a positive temporal difference. The taxable temporal difference is a positive temporal difference. This one is positive. Temporal difference. And this one is a negative temporal difference. This is a negative temporary difference. So now we can be able to answer the second part of that question. Because I've said this one, balance sheet is the one which is recommended, meaning that we go to this route. When computing deferred taxes, this method is the one which is recommended. So meaning that when you will be doing your deferred tax, you follow this route of temporal difference. So you say temporal difference, carrying amount minus tax base. Carrying amount is cost minus accumulated depreciation. Tax base is cost minus accumulated capital allowance. So types of temporal difference, we have taxable and deductible. So the taxable temporal difference is a positive temporal difference, whereby the carrying amount is greater than tax base. It leads to a deferred tax liability. For the deductible temporal difference, it's a negative temporal difference, whereby the carrying amount is less than tax base. It leads to a deferred tax asset. Let's look at that question of April 2023. Question 5B, Roman 2. So we continue. So the same question, that we need of deferred tax to compute the deferred tax. Another 4 marks. Another 4 marks. So looking at the second part, the deferred tax. So we have said that deferred tax. How do you compute this? Temporal difference. Because now the method which is recommended by IS 12 for computing deferred tax is the balance sheet liability method, which says that deferred tax is temporal differences times tax rate. And you know how to compute temporal difference. I don't want to repeat myself from time to time. So this question is that of a BXL manufacturers. BXL manufacturers. Taxable profit, not taxable, temporal computation of temporal difference. Because once we have temporal difference, we multiply with tax rates. Computation of temporal differences. So you'll give me around a minute, then we continue. So there's someone who is asking that it doesn't show it. No question, my end. I don't see assets and liabilities in the question. See, there's one asset called equipment. Are you not seeing that, Abraham? So BXL manufacturers computation of temporal difference. So that is for the year. For the year ended. Are you seeing that asset? For the one who was asking that he's not seeing asset. For the end, ended 30th June. So remember that here we talk about the year. We know the temporal difference is carrying amount. You minus tax base. Once we deduct the tax base, we'll be able to get our temporal difference. So after temporal differences, remember that if I get my total and multiply. Anyway, for now, let me get first temporal differences. Then I will be able to tell you how to get your deferred taxes. So we have 2019, year ending 2020, 2021, we have 2022. So to get your carrying amount, remember this is carrying amount. Cost minus accumulated depreciation. Remember that our depreciation was 333 on a straight line basis. So you accumulate, and the value of the asset is 12. So 12 minus 3. For the first year, we get what? 12 minus 3. This is something you are supposed to even know.
9.
Sorry?
9,000.
You get 9,000. 9,000 minus another 3. 6.
6,000.
This is 3. This is 0. Tax base is all about the cost minus accumulated capital allowance. So you know your capital allowances, the way they were, you use the 40%. 40, 30. It was 40, 30, what and what? 40, 30, 20, and 10.
Okay.
So you applied on the 12,000. So 12,000 now minus the first one. The first accumulated capital allowance was
4,800.
it was 1,400.
Yes.
So give me the answer. 12,000 minus 1,400.
4,800, not 1,400.
4,800.
Yes.
4,800.
Oh, that is
You get
7,200.
72. 72 minus the second one was 36.
Yeah, 3,600.
You get 36.
Yeah, you get 36.
36 minus the third one was 24, I think.
Yes, 24.
You get 12.
You get 12.
And the last one is 0. 9,000 minus 72, you get 9. Temporal difference.
1,800.
Go to 1,800. This minus this.
2,400.
This minus this.
1,800.
1,800.
1,800.
Mhm.
0.
0. So you have to create one column here for deferred tax because they need an account. So how do you determine deferred tax? It's temporary difference times tax rate. That is what you do. So 30% of this 1,800 you get.
540.
So this is 540. The next one is
720.
720.
Yes,
The next one
540 as well.
540.
540.
540. 0.
0.
Mhm.
Yes, that is what they needed. Oh, they needed an account. No, they needed deferred tax. That is what I have answered. Yeah. The first part of the question was in need of what? So in short, what we have done here for computation of temporal difference is all about, remember that we have the years 2019, 2020, 2021, 2022. Carrying amount is all about the cost minus accumulated depreciations. And we know that it's on the asset. And you are given an equipment there at 12,000. So you minus your accumulated depreciations. Depreciations on a straight line basis for each year was 3,000. So you go ahead accumulating so that you take 12,000 minus 3,000 for the first year as you go down, deducting. The same way for the tax base, you take your cost minus accumulating capital allowance. The capital allowance were based on these percentages. So we have taken the cost minus the capital allowances we got based on those percentages. And once you check your carrying amount minus tax base, you get your temporary difference. Then to get your deferred tax, remember it's temporary difference times tax rate. So the first, there was a theory part of the question whereby they were asking that there's someone making a lot of unnecessary noise. The guys who are unmuted. So in context of the International Accounting Standards 12, income taxes, explain differences between taxable, temporal difference, and deductible. Have I answered that or not? I have answered that. Suggest how the tax base of assets, revenue received in advance, and other, yes,
Please regulate the different the Roman one, the answer to Roman one.
Sorry?
I want to note it down. The answer to Roman one, but answer it, but please regulate.
I've even shared the answers. Have you realized that? So I said the taxable temporal difference and deductible. So I explained, guys. Taxable temporal difference will result in a taxable amount in determining taxable profit of future periods when the carrying amount of the asset or liabilities recovered or set. It's not a must to give all these explanations. You can say for taxable temporal difference is when the carrying amount exceeds the tax base. It's a positive temporal difference. It leads to a deferred tax liability. The same way you can give also this explanation they have given here, that the taxable differences will result in a taxable amount in determining taxable profits, the tax loss of future periods when carrying amount of the asset or liabilities recovered or settled. But also the explanation I gave is equally okay. So for deductible, I said is when the carrying amount is less than the tax base. It leads to a deferred tax asset. It's a negative temporal difference. Here they have said that temporal differences will result in amount that are deductible in determining taxable profit or loss of future periods when carrying amount of the asset or liabilities recovered or settled. So then they asked about what? The second one they asked about suggest how the tax base or for assets, revenue received in advance and other liabilities can be determined. Also, this one is well explained under these answers for the assets. So they have said that for the assets, the tax base of an asset is the amount that will be deductible against taxable economic benefit from recovering the carrying amount of the asset. So when recovery of an asset will have no tax consequences, the tax base is equal to the carrying amount. For revenue received in advance, the tax base of the recognized liabilities carrying amount, less revenue, that will not be taxable in the future periods. Other liabilities, the tax base of a liability is the carrying amount less any amount that will not be deductible for tax purposes in respect of that liability in future periods. So then there's two exemptions for the requirements to the recognition of a deferred tax liability. Liability arising from initial recognition of goodwill, and we have liability arising from initial recognition of assets or liability other than in the business combination, which at the time of the transaction does not affect either the accounting or taxable profit at the time of the transaction. So for theory, since you have this, you can be able to read in between the lines and interpret more. So this is what we have done for taxable profits. That is how they were marking it. Out of all the entries we did, any correct 4, you were to score your 4 marks. And for deferred taxes, also all the entries we have done, any 4 correct entries, you were to get your 4 marks. I've said this question is a copy paste from 2012. You can go to 2012 and check the one which is there, and you will be able to do for your practice. Is that okay? So for theory, you will be able to read from the document I've shared.